for the introduction. Good afternoon, everyone, and welcome to the panel session on geopolitical risks. As we have already known, and as we have heard at some of the morning sessions, current geopolitical landscape is quite challenging, maybe more than ever. In a nutshell, we have seen a rise in economic nationalism, protectionism, military actions, shifting alliances, technology and climate disruptions, and also fiscal and monetary policy shifts, and all together resulting in a huge increase in financial market volatility. So all of this make the picture quite challenging to navigate, both for investors and policymakers. And about this increasingly important topic and potential implications to our region, particularly to Central and Eastern Europe, including Balkan countries and Turkey, of course, I will talk today with our distinguished guests and top experts for the financial industry. So welcome and thank you for being with us today. And we will start with world topic number one, that would be US trade policy. Since the new US administration assumed office, there has been a continuous flow of news characterized by unpredictability, whether intentional or not. So this is naturally led to the question whether the trade policy serves as an economic policy tool or as a negotiation strategy. So although the CEE region is not in the center of the trade wars, it will for sure be affected both directly and indirectly, given that many countries within the region are small and open economies. Mr. Fatih, how do you assess the impact of US trade policy on economic growth and inflation within the region?
Thank you, Natasa. First of all, the landing zone of US trade policy remains unknown. And as Minister and Mr. Birol mentioned, the uncertainty is extremely high. But we assess for now the situation has evolved from a case leading global recession to things will bend but not break, meaning economic activity will slow down globally, but it will not lead global recession. So these two scenarios are extremely different, and it has a drastic changes when it comes to its impact on CEE region. We have lowered our growth projections for CEE by 1 percentage points on average after the announcement of US tariffs. And we also lowered our inflation forecast by around 0.3, 0.4 percentage points on average in CEE region. So as you can see, JP Morgan sees this shock as external demand negative shock to the CEE region. So what are the main channels? Obviously, the first one is trade channel. We think CEE exposure to US trade is residual, both in direct and indirectly through Western Europe. We think, overall, this impact will be negligible when you look at OECD's trade value-added database. It is also evident, and when we do our analysis at JP Morgan, we are seeing same picture. But the second channel is the most important one, right? It is investment channel. And Minister highlighted many uncertainties. I think we are on the same page. We will see businesses are having hard time to make midterm decisions in terms of investments. So we will probably see also Chinese threats to CEE auto sector, right? Because CEE is well known for internal combustion engine, parts. So I think it will be also threat. And obviously, third channel, as Mr. Birol mentioned, commodity price channel, which is positive for CEE, particularly for Hungary. And it will have a downside pressure on inflation. We think that part will compensate some losses from the investment side. And obviously, fourth channel is the coming from global liquidity, meaning risk of mode for overall emerging markets and has CEE. So that creates this uncertainty for the short-term inflation outlook, because as we all know, when we see risk off, emerging markets currency sold off. Right now, the markets have stabilized, but we think the volatility will continue, and hence policymakers, particularly central banks in the region, should be quite cautious about rate cuts. We added a couple of rate cuts for monetary policy outlook, but we think financial stability concerns will be another important anchor for monetary policy decisions going forward. So we will watch out what will happen on US dollar and geopolitical tensions going forward. We have a call for euro-dollar exchange rate at 120, which is really good for the region. But obviously, the risks are still elevated. And, I personally think the US-China war is here to stay.
Thank you very much for sharing your insights with us. This is definitely something that will stay with us for quite some time. If we now look at this part of the Atlantic, the fiscal policy shifts in Germany with increased spending on defense and infrastructure is something that is closely watched, especially if we take into account that Germany is the main trading partner of many of CEE countries. Mr. Erich, how much positive spillover from relaxed German fiscal policy should we expect, and how would that affect the credit ratings of CEE countries? Can that at least partially offset the negative shock from US tariffs?
Thank you, Natasha, and thank you to the CFA Society for the opportunity here to share some of our views, but also the opportunity to hear questions and opinions about not only the region, Turkey, but also the current global context. So we appreciate very much the forum. In terms of Germany, certainly it's a big news in the sense that you have a traditional, let's say, constraint on fiscal policy being lifted. And Germany apparently beginning to try to focus on two areas which have been lagging: investment infrastructure, as well as increasing investment in defense. So from our perspective, we see that the 500 billion euro infrastructure fund, plus what it means actually to lift the constraints of defense spending above 1 percentage point of GDP, could amount up to 900 billion, 1 trillion euros of expenditure. That, for reference, is about 21, 23 percentage points of GDP of Germany. If you think that potentially NATO may actually increase the requirement for members to lift defense spending above 3%, then you start thinking about even bigger numbers. So that's significant in a way. But based first on just the current announcement and the figure of close to 1 trillion euros, we think that it could add to German GDP on average about 0.4 percentage points between 2025 to 2027. And that's, of course, taking into account that it will take some time and maybe a gradual ramp-up of investment. So as you correctly point out, it represents a positive factor in the near-term as sentiment, because in all this very difficult to understand world and the challenges that Fatih has outlined, it's always welcome to have positive news. Nevertheless, there's a timing issue and execution issue, and this is what we're focused on. Timing in the sense that we are assuming there will take some time to actually start to ramp up the investment, directed infrastructure, and scale up defense spending, and that will be subject also to some constraints regarding labor market, for instance, in Germany, industrial capacity, and the capacity also of the defense industry to actually get to economies of scale. So that's one challenge in the timing. The other one has to do with the capacity of the region as a whole to benefit from this additional German spending. Traditionally, as you well point out, Germany is a key driver of growth for the region. But in this type of stimulus, specifically directed towards infrastructure and defense spending, it's the capacity of the supply chains to readapt and provide the components or production needed to ramp up that type of spending. So that's a question that may take some time for us to assess more rightly. So in the near term, we have tariffs, the uncertainty, which is very negative for sentiment and for growth. We have this expectation that things can actually provide, the German spending can actually provide some upward momentum on external demand to the region, which has been severely lagging. But it is not something that is going to happen in the near term. Now, regarding ratings, I think that here we are a little bit much more prudent in the sense that we think that the main challenges right now for the CEE region, especially looking at Eastern Europe, is on the fiscal side. You have had successive shocks where debt has increased. If we take a matter of comparison, right? For the CEE region, and if you add that, Caucasus, CIS, you have had an increase in debt of more than 10 percentage points of GDP since 2019 and 2024. And debt right now, about hovering around 55% of GDP, is no longer seen as a strength relative to peers. So that's one. And it's not about level, but about the flows. So fiscal deficit now is about 5 times higher than what we had pre-pandemic. So yes, the German stimulus can provide some uplift, but that uplift will have to provide in support a fiscal consolidation process, which, as we know, based on the recent political developments, is not the only variable. Right? There's also domestic political considerations, and that also plays a role.
Thank you very much for sharing your views on that. It's definitely something really relevant for the region, and not just shifts in German policies, but in the EU as a whole. We know that EU's foreign policy and strategic autonomy are increasingly becoming a focus of discussion. So regarding that, Mr. Matteo, how do you think the role of multilateral institutions in funding infrastructure, development, and also climate-related projects evolve in response to shifting geopolitical priorities in the EU?
Okay, thank you, Natasha. So I must admit that in the EU institutions, we are not in the business as usual mode. So we are, I don't want to say agitated, but very active. So we are playing a role, and this role is more and more asked by other countries, other players. They see Europe as an oasis of stability. And so we need to play the role. So European Investment Bank is mainly financing the EU Commission, EU priorities. These are the climate transition, so more than 50% of our lending is going to climate, which means energy, adaptation. Last year we reached 60% target. Then the importance of critical raw materials, defense and security is becoming very important. And this is maybe a big shift we have seen. So we've been doubling the amounts dedicated to defense and security last year, and we will double this year. And especially we are enlarging the eligibility. So we are not financing any lethal weapon, but we are financing many other things, including technologies, drones, optics, satellites, military barracks, and so on. So there is a big push on the defense sector, which is including very much the digital part and cybersecurity. So it's not only to be ready for the traditional war, but especially the hybrid war that is already there. So EU institutions are, let's say, very active also in building bridges with countries outside EU. That's very important, especially for the candidate countries, Western Balkans, Ukraine, and others, but also outside EU, so for the neighborhood. And we are building a lot of partnerships, and we call it win-win partnerships because there is a reciprocal interest. And some of this is visible with the trade agreements. So there are an increasing number of trade agreements upcoming, especially the Mercosur, that is, let's say, is a testimony of trying to increase the role of Europe geopolitical sphere. On the other side, there is a very limited number of reserves. Maybe, I don't know if this number will shock you, but the EU budget represents 1.3% of EU GDP. 1.3%. Turkey or other countries probably 45, 50%, depending on the country. EU is only having 1.3. So we are very careful in leveraging these resources with systems of guarantees and lending. and allocate properly and very targeted, and especially for the priority sectors. So the resources are scarce at EU level. You cannot have a deficit like another state. At the same time, the states, as was mentioned before, they have a very strong constraint locally. So that's a very important moment because there are huge investment needs that are long-term drivers of growth, and on the other side, limited resources. So that's the game right now.
Thank you for your answer. And now if we turn again to a more global perspective, the de-escalation of between the US and China has come as a major relief to the market. Fatih, what kind of a permanent agreement do you think is sustainable?
I don't want to be pessimistic on that, but we are. JP Morgan's house view is that US sees China as the biggest competitor, not only economically, but also militarily. So from perspective of US, China is a matter of national security too, right? So there is no trust between US administration and China administration. And hence, the noise will be with us, right? And we have also US electoral cycle where we will see midterm elections in November 2026. And we expect an escalation in trade war heading into the US midterm elections. And definitely, we will see some sort of a trade war ceasefires like we had seen right now, but the path will be volatile and noisy, I think, and we don't know what is the landing zone on US-China trade tensions. So that's why we are on the camp that the best permanent solution should be a competitive coexistence, meaning US and China should collaborate in strategic sectors like semiconductor, critical minerals, and also these AI-related materials. But on the non-strategic sectors, there should be clear guidance between China and US. This is the optimal solution, but we are not hopeful that it will happen anytime soon. And we had seen that China is more willing to accept the pain than the US, as there is no elections every 4 years in China. So US blinked, and I think China is at upper hand on this trade war. Overall, again, the path is volatile. We don't know the end game. So it's a massive uncertainty, particularly into US midterm elections in November 2026. But we hope for a competitive coexistence between China and US, as JP Morgan, obviously.
So more or less, we should prepare for the worst and hope for the best.
Yes.
Apart from the US and China, another important relation, especially for our region, is between Russia and Ukraine. Recently, negotiations were held here in Istanbul, unfortunately without an agreement. Mr. Erich, what is, in your opinion, the outlook for the Russia-Ukraine war, and what would be the potential implications to CEE region, especially regarding energy security? And also, how do you see the role of the US in this process?
Okay, so I guess that the main view or central view we have, if this year there will be some sort of ceasefire agreement with emphasis on some sort. But let's say thinking about a durable peace settlement between Russia and Ukraine, we see that as very difficult because of the conditions or preconditions established by both parties. The role of the US, of course, has, let's say, provided some momentum in order to start discussions about these issues directly. And we see that very publicly, the US has stated a lot of, let's say, intent in trying to bring an end to the conflict. However, as with tariff policy, the US objectives, means, and endgame for this negotiation or discussion are rather unpredictable. So what is likely is that we'll end up with a ceasefire that will not help reduce the geopolitical risk that have arisen because of the war. Hence, the potential peace dividend for Ukraine or the region will be much more limited. Taking a step back and thinking about the CEE region and the impact that the start of war had, we saw, of course, an increase in energy prices, which had led, especially in certain Eastern Europe, to a policy response on the fiscal side. So for us in Fitch ratings, for the region, a lot of that comes back to the fiscals and public finances. So a lot of the support that the governments had to provide, both in terms of energy, but also social, has actually made the fiscal challenge much more difficult after the pandemic. And in the context of this uncertainty regarding who provides and what kind of security guarantee, not only to Ukraine, but to Europe, the additional source of pressure we're seeing building, of course, is defense spending. In March, our team looked at, what the potential scenarios would be and what we'd be expecting in terms of ramp up in security spending. And we thought about two levels of countries. Those are to eastern flank that feel more threatened by Russia, around 5 percentage points of GDP. Poland is already there, Baltics moving towards there, and 3 percentage points on average for other countries in Eastern Europe. Now, recent announcement I've discussed from NATO, maybe we are a little bit more on the conservative side, and certainly other countries like Estonia are looking probably to lift it further. So this fiscal challenge will remain. So if the war is settled in the terms that apparently will be, without security guarantee, and with concerns about NATO members, about the commitment of the US to mutual defense, that those pressures are much more permanent. When we think about, let's say, the Caucasus, they had, let's say, a positive spillover from the conflict in terms of labor, capital inflows, redirection of trade. We think that those won't reverse, even if there is a settlement or an agreement in the Ukraine war. But certainly, the challenge is to what extent, for instance, sanctions will be eased, and whether the sanctions will be eased asymmetrically, meaning that the US, in order to reach an agreement, will ease sanctions before the Europeans. And as far as we know, based on policy guidance and statements, probably there will be some difference in the application of sanctions, how tight sanctions are going to be. So not necessarily, a situation in which we can say that the distortions in trade flows, as well as the constraints, the reduced energy reliance of Europe and Russia will revert. Now, on the energy question, we think that at the time, probably the uncertainty regarding tariffs impact on growth are much more an impact on prices. If there is let's say, normalization at some point of relations between Ukraine and Russia, maybe there's some slight improvement or benefit for oil and gas consumers. But in the end, also we believe that stated policy of Europe is try to reduce dependence. So the challenge is for that. Europe still imports around 14% gas, for instance, from Russia. So are they going to be able to reduce this up to 2027? And also taking into account that still Europe, although they're very diversified, they're still dealing with the competitiveness challenges from actually reducing energy imports from Russia. So to summarize, we are not likely to see a peace dividend. Actually, some of the challenges will be lingering. Geopolitical risk will remain very much so in relation to Russia.
Thank you for answering this tough question. Unfortunately, military actions in key regions like Eastern Europe, Middle East is something that we for sure closely follow these days. We have mentioned energy security and the importance of access to key resources. Mr. Matteo, what do you see as the key economic risks emerging from the intersection of of geopolitics and climate change. How might the shifting priorities on energy, resource scarcity, and sustainability reshape the global economic order?
Okay, so we have seen in the last years, I would say even before Trump, that geopolitics has always been important for the economic side, but this time it seems that geopolitics was really invading the economic sphere, and that's why we are talking about that actually. And this is prominent, really, also in a rather stable continent like Europe. So there are various things. One is energy, as you mentioned. So let's say, being more independent from Russia, and this means pushing very much on renewable energy. This is growing a lot in Europe. It is now 50% of electricity production is coming from renewable, today we have seen, and around 25% is coming from the total energy consumption is coming from renewable. This is growing every year. And for the Nordics is double, so we see already where it is going. Then there are the critical raw materials. There are 29 critical raw materials identified as key for the transition, and they are coming from only 13 countries in the world. So that's very important to have a special focus on the materials and on the countries. And then many other things are related with the general security, because we are talking about energy, critical raw materials, defense and security, and I would say a global concept of competitiveness. So competitiveness is twofold. One is the general competitiveness of the economy, like sort of productivity, including education, innovation. The other one is strategic autonomy. So this second block is very important for defense, for pharma, for some specific sectors where there must be focus. What is very relevant is that these things are relevant for Central Eastern Europe. So Central Eastern Europe firms are telling us that they are worried about the climate transition. So they are not so prepared like in Western Europe. So there is a big opportunity for investments in Central Eastern Europe in this regard. Defense, we have mentioned Poland and the Baltic states. They are going close to 5%, and defense is very important, of course, for obvious reason when you are on the eastern side. So that's fully coinciding with the priorities of EU. And many other topics are, let's say, very, very relevant for Central Eastern Europe. So Central Eastern Europe is playing an increasing role economically, but also from the defense point of view, and also geopolitically for the entire Europe.
Thank you very much. I have a lot of questions for you, but unfortunately or fortunately, we don't have enough time for all of them. I will now take time to pose one question for the audience. You can answer using the app on your phone, Slido. And the question is, looking ahead, what do you see as the biggest geopolitical risk in the next 5 years? So the offered answer choices are escalation of the US-China trade war, B, political polarization and populism, C, military conflicts, D, economic inequality and social unrest led by artificial intelligence, and E, climate change and resource scarcity. And while we are waiting for results, I will ask my esteemed panelists, what would be your answer on this one? We can start with Erich this time. Tough choice.
Yeah, no, I think I will go with political polarization and populism. I think that some of these risks or challenges require long-term state-type policies and international cooperation, which the dynamics that we see in many countries are not conducive to. If you have still to debate issues like climate change, if you have still to debate, the concerns about minority rights, immigration, I think it gets tougher, right, to actually tackle these issues, right? So I would think that political polarization is...
I would vote for the same, actually, because, yeah, my concern is that there is prevailing the concept that the things are not solved together, but are solved against the others, and that's very wrong, especially in Europe.
Thank you.
Globally, I will say escalation of US-China trade war, as I highlighted in my speech. But for the region, I do agree with my colleagues. I think political polarization and populism is the biggest issue in CEE too. I am not talking about only the rise of far right, by the way. I am just talking about the anti-establishment, political forces. Because, for example, in Hungary, we have also really decent competitor to Orban, and Hungary is known for, I would say, illiberal democracy practices. So it's not only, far right, it's more of a anti-establishment political forces with no, clear future vision to address the challenges we highlighted in the panel.
Thank you. I would agree with you. And I don't know if we have the winner from the audience, but obviously the winner from the panelists would be answer B, political polarization. So thank you very much for being with us today and for all the valuable discussion we have had. And big thanks to the audience as well for your attention. I will conclude this panel with a line that actually I faced while I'm preparing my CFA exams, and it goes, always expect the unexpected. So thank you very much for your attention.
Thank you. Thank you.